What's up, y'all? It's your boy Al, the owner and founder of TICKR Finance and TICKR Apparel, where our mission is to close the wealth gap in the U.S. with dope fashion and crypto assets. You can visit www.tickerapparel.com to learn more. There's also four of our premium t-shirts that are available for sale. We are looking at expanding the line, but right now we have these four shirts. They'll eventually be collectors items, but they'll probably be NFTs. I may make them NFT. That might have to happen. And I didn't even consider that up until now. It just hit me. Maybe I should make them NFTs. Okay. Cool. I'm gonna go ahead and get into it, man. I'm pretty excited about today's. And I know y'all tapped in and want to know, okay, what's really happening, what's really going on. So the question is the bubble bursting? Is the stock market bursting? Is the housing bubble bursting? Is the crypto market bubble bursting? Is everything about to go to the crapper or to hell in a handbag? I mean, there's quite a few uh, metaphors and sayings you could throw out there, one liners you could throw out there, but is it over? Inflation is running really, really hot, like really, really hot. And so for you guys that don't really kind of understand the way this works, uh when when demand outpaces supply, prices go up. That's what inflation is, essentially. Demand is outpacing supply, and so the prices are going up. We've seen it with commodities, specifically oil. The U.S. has like tapped into the reserves to try to quell some of the oil uh, reserves and the prices from going up, but there's still record people booking trips to travel. People haven't been out in 2 years, so a couple things happened. We got two stimulus packages. Uh, we had the PPP loans. And then when interest rates dropped to nothing essentially at the beginning of C19, then a lot of people either sold their home or did a cash out refinance. So they either got a lot of cash on the side or they made just about any investment right after COVID, after the initial panic, was a good investment. So if people refinanced, took money out of their house, sold their house, had a six-figure check and then invested it or bought a new home or whatever they did, and now they're up exponentially or quite a bit since reinvesting that money. There's just a lot of money in the economy. And so interest rates have to go up, and they have to go up considerably. The reason that's important is because a lot of spending happens based on borrowed money. A lot of investment happens based on borrowed money. And as money gets more expensive, people are less likely to spend using credit cards and invest using debt, which they have an interest rate on that they have to pay. So, just to give you guys an example of how much interest rates, especially for 30-year mortgages, have jumped in just about 16, 17 months. I refinanced my home at the beginning of 2021, closed on in like March. So it's been roughly about a year. And we got the best rate. My wife and I was like 2.75 for 30-year mortgage. Wonderful. Right now, April the 28th, if you're just going to go qualify, if you haven't been qualified before now, if you're just now going to go qualify, a 30-year mortgage is, I think I saw it at close to 6%. It's like 5.75. So it's about a 2.5x, 3x increase in interest rates. Now you may think, that's not that much, but over 30 years, this starts to price people out of certain range of houses that they were hoping to get. Because that's gonna, as the mortgage goes up or as the interest rates go up, that's gonna increase your monthly payments. So you're not paying more for the house, but you're paying more for the money that you're borrowing to buy the house, which means your interest rate is going to go up. So that's not good. Same thing's going to happen across the board with credit cards, everything, car loans. Uh, but the thing is, going back to what I previously referenced, because there's so much cash in the system, and people have used it well or either they've just hoarded it and they got a stockpile of cash. The inflation as it currently stands hasn't had the impact or hasn't scared people the way the federal government and the Federal Reserve Bank thought it would. And so we had an interest rate increase, I think, back in March of about 25 basis points. Right now, it looks like the Fed is going to raise interest rates by 50 basis points the next time, and they're going to have to hike it up a few more times. So ultimately, what does this all mean? And, how is it going to bring everything to a screeching halt? There's a video I'm going to pull. I actually hadn't watched this particular video, but let me see. We'll go with this one. I have to put my this is a 12-minute video. The dot-com bubble. Let's talk about dot-com. So this is the housing. Me, Kevin has some good stuff about the housing bubble too. Here's this guy talking about it's over. The NFT bubble just popped. Again, there's a ton of these platforms. I hadn't watched that one, but as you guys can see, 2 weeks ago, 11 days ago, 5 days ago, over the last 2 weeks since the stock market started kind of dipping and crashing, a lot of people are asking, is this over? It's been my experience when you're in a rising interest rate environment, risk assets, stocks, crypto, these are things that are considered risky, are going to take a hit. And that's what we're seeing. When is it overdone? I mean, I don't have a crystal ball to say, but that's just generally what happens in an inflationary environment. The question is, are we entering hyperinflation? Now, you guys can do some research. You got a little homework. I'm about to give you some homework. You go look up hyperinflation like 70s and 80s. So this has happened before. My parents told me a story when they bought their first house. I think the interest rate on the house was like 12%. Like crazy stuff was happening. And so this is where we are now. We're not there at the moment, but we're getting there pretty quickly. And it could surpass where we were in the late 70s, early 80s. So, again, as things get higher, more people are going to feel the pain of things getting more expensive. And so as that happens, you're going to see consumer spending slow down. And the unfortunate thing as well about if the bubble has burst and this is the end, and we do go into some sort of hyperinflation environment from a financial standpoint, heaven forbid people lose their jobs and things of that nature. But if this is a true economic shock where businesses have to either pause hiring or start to lay people off, stimulus checks aren't coming. That's the thing about this. The government was able to kind of provide a bridge to the other side with the last two stimuluses and these PPP loans. But for businesses and individuals, I'm here to tell you, if things are getting ugly this time, it's going to be extremely difficult to have that smooth bridge over to the other side. So I'm going to go ahead and press play on this video about is the housing market over. It's over. The housing market bubble just popped from Graham Stephan. We'll see what he talks about on here.
Hey guys, so really quick, I want to address a previous controversy. In a previous video, I tore up this $100 bill to illustrate how the Fed removes money from the economy. I understand that this was upsetting to some viewers, but rest assured, no real money was harmed in the making of these videos. And in fact, the only things harmed were these fake $100 bills from Amazon that you could buy for pretty cheap. So now that we've settled that, what's up, Graham? It's Guys here. Well, they've done it. For the first time in a long time, housing prices are beginning to cool down with something we have not seen since 2008, a price drop. That's right, CNBC now reports that sellers are beginning to lower their asking prices as buyers are paying 38% more for their monthly mortgage payment than a year ago, right as the Dallas Federal Reserve called.
Okay, so I want to stop there real quick. And you guys, he's going through some of this inflationary story, but year over year, price increases of mortgages, 38%. This stuff is not sustainable. So what I've seen when the last stock market and housing market crashed, typically when you get this hockey stick ending, so if you guys know how hockey stick looks, of course you got the stick part itself and then kind of the arm or handle at the end that you hit the hockey puck with. Well, the stock market can have, when you hear people refer to like a hockey stick chart, it's that kind of flat line and then this rapid ascent. And this happened to a lot of assets and their pricing over the last, 12, 24 months since C19 hit. So the stock market, hockey stick. I mean, you had big tech blue chip companies that basically were trading like small caps. You guys have to understand, typically somebody Walmart, like it was wild. Typically the boring blue chip names don't have a lot of volatility. But in this environment it did, just because there was so much money at play. More than there had ever been. There's still a lot of money in the system. So I'll let this ride to see what Graham's talking about.
For a housing market bubble. So given how unaffordable the housing market has become, with record low inventory, buyers willing to pay $1 million over asking, and others offering up the name of their firstborn child, let's discuss the new developments in the housing market, what experts predict is going to happen over the next 1 to 3 years, why housing prices are beginning to drop, and finally, how millennials have solved the retirement crisis, because this is surprising, even to me. And I thought I'd seen it all. Anyway, let's talk about all of that and more on today's episode of Am I Wearing Pants? To which the answer is, I'm not going to tell you. Although before we start, I heard a rumor that for every like this video gets, a first-time home buyer gets their offer accepted. Okay, I have no idea if it's true. The March 2020 interest rate reduction allowed homeowners to lower their monthly payments while simultaneously giving them more purchasing power at the exact same time, thereby causing prices to go up. Second, the shutdown resulted in a record low number of homes on the market. And with a severely reduced supply, that leftover inventory was bid to an even higher amount. Third, supply chain bottlenecks meant that housing materials took longer to arrive, they were more expensive, and consequently that cost gets passed on to the consumer, which, you guessed it, causes even higher prices. And fourth, labor shortages also fed into the overall cost of housing, because with fewer people available to do the work, they either charged more for their time or fewer homes were built, leading of course to less inventory. All of that happening at the exact same time led to a very unique situation where housing prices rose to their fastest level in
Okay, I think so I think I just I'm super tired right now, guys, while I'm trying to pump this content out. Been doing some ripping and running. Hopefully I didn't I didn't doze off. I felt like I had a long blinking head. That's gonna be funny. I'm sure when this lives on YouTube, you guys will let me know, bro, did you just go to sleep during the damn video? I gotta go back. I'm just gonna post it and then I'll watch the replay. Anyway, he's going through the ingredients that's created this inflationary cocktail. So he talked about the low interest rates, the job shortages, the increase in like average wages being paid. A lot of this stuff, all this money coming into the system, has created the current situation. And so let's let it run a little bit more. But he's just kind of going through that. And you guys might see me skip through some of this again. I actually hadn't seen this video, and Graham has a pretty big channel, and so I just wanted to see what he had to say and what his thoughts were. All right, let's go to play.
well, pretty much ever. But that could soon be coming to an end, because for the first time in a very long time, we're beginning to see a new shift in the market. And here's what's being discussed. Throughout the last few weeks, the Federal Reserve has been on a mission to raise interest rates and halt bond buying in an effort to combat high inflation. But the very obvious and very quick consequence of that is higher interest rates for everybody on everything. In fact, mortgage rates have risen at their fastest pace in 30 years, and the expectation is that they're about to go even higher. Much, much higher. Although the biggest impact in relation to this video is going to be home affordability. And to break it down a little bit further, here's what I mean. If you're in the market for a home and you've been approved for a $1,500 a month payment, you could afford a $350,000 loan at a 3% interest rate. However, if rates increase to 5%, the maximum you could borrow is now $275,000, which means you'll either need a much bigger down payment or you're buying a less expensive home. So as you would expect, with interest rates beginning to increase, home values are beginning to take a hit. And as a result, result, sellers are doing the unthinkable by lowering their prices. CNBC reports that the number of new listings last week jumped by 8%, right as the average borrower is paying 38% more than they would for the same home a year ago. In response to that, 12% of homes had a price drop, which is 9% higher than a year ago, with these kinds of drops occurring faster each month. Redfin went on record to say it goes to show that there's a limit to sellers' power. There's still way more demand than supply, and buyers are still sweating, but sellers can no longer overprice their home and still expect buyers to clamor at their door. However, we should just cut to the real juicy story here with a warning from the Dallas Federal Reserve that we have entered a housing bubble. Now, first of all, it's important to recognize that just because something goes up in price doesn't automatically make it a bubble. After all, there is an element of supply and demand, increased cost, and a local job market that could positively influence prices higher. But in this case, the Dallas Federal Reserve has warned that the housing market has diverged from market fundamentals, where there is widespread belief that today's robust price increases will continue. Or in other words, when a buyer purchases a home only because they believe that prices will go even higher, that is a sign of irrational exuberance, and that is the issue that we're seeing today in the market. As they say, this can continue pushing prices beyond their fundamentals until investors become cautious, policymakers intervene, the flow of money into housing dries up, and a housing correction or even a bust occurs. So to look for a tipping point, they search for signs where housing prices have exceeded what economic fundamentals could justify, and what they found was quite surprising. They show that from 1999 through 2008, the market experienced irrational exuberance, just like it's showing now from 2020 until who knows how long. Of course, this data means absolutely nothing without the analysis behind it. So to call it a bubble, they look for an imbalance between the rental to home ownership costs, along with price to income, to determine whether or not we're in this irrational exuberance phase. And the answer is yes, kind of. Even though there's an imbalance between the price.
Okay, so Graham's done a pretty good job laying that out. I won't extend the video much longer, but I might try to fast forward to the end. But you guys can see there's remnants of a bubble. And, again, I'm in the middle Tennessee area. There's a lot of people moving in. Tennessee, Nashville specifically, was rated the second best job market in the country, only behind Austin, Texas. And so Nashville and Austin really have been competing with each other as like best reasonably priced, affordable, nice city to live in the United States, probably for the better part of 3 or 4 years. And that's not stopping anytime soon. In any event, Graham's kind of walking through this cocktail and what the housing bubble is looking like. I want to see if he's going to talk about like what happens if or when it crashes. He's just telling you guys kind of what makes up the bubble and why this looks similar to a previous time. So back from what do you say, 97 to like 2008. But I'll let it run a little bit more and we'll see if we can get a little bit more information.
Price to rent ratio, price to income is higher than normal, but still not irrationally exuberant. They explain that recent patterns may prove to be a less useful measure of home affordability because low interest rates and stimulus allowed more money to be spent. Although overall, they still did come on record to say that they do see abnormal housing behavior for the first time since the early 2000s, simply because prices are increasingly out of step with fundamentals. Now, on the bright side, they do admit that household balance sheets appear in better shape and excessive borrowing doesn't appear to be fueling the housing market boom. So in terms of what the experts believe is going to happen in the housing market over the next few years and why millennials have solved the retirement crisis with cryptocurrency, here's what you need to know. Although before we go into that, while we're on the topic of cryptocurrency, real talk. Calculate every sign up using remain elevated. Not to mention, housing inventory has been on a steady decline since the early 1990s. So the chance of more homes getting built is probably not going to happen. Is go to buyers with a credit score exceeding 760. Lending standards have increased and homeowner equity is at a record high. To rise, but at a slower pace. For instance, the Mortgage Bankers Association predicts a 4.8% increase throughout 2022. CoreLogic expects a 6% increase, and Realtor.com predicts a 2.9% increase. Now, granted, inflation could very well be higher than those numbers, so we might actually see a net decline. But regardless, this type of real estate market cannot keep going forever. But at least for the next few years, I could see housing prices remaining fairly robust as long as there's limited inventory on the market. But just
Okay, so that was good. Seems like his bottom line is, uh, yeah, it's kind of in a bubble, but due to low inventory and still relatively high demand, we won't see a potential bubble bursting for another few years yet. So, um, I let the good times roll, right? Like if you're out here getting money and getting to it in the real estate game, more power to you. Uh, keep your eyes open, keep your head on a swivel. Watch out for this inflation. Watch out for any signs of, excuse me, especially a deteriorating job market. Once companies stop hiring or put a pause on hiring, that has the potential to be catastrophic for people who are job seeking, and just anticipating and finding work, and then it doesn't happen. So, uh, yeah, I didn't want this video to run too long. I could go into the other bubbles. Maybe I'll do that in another video where we talk about the stock market and the housing. I might pull up your boy Harry Dent. He's a different animal. uh, he's like King Bear, but he got some valid stuff going on, and his predictions are very grim. I always like to have a well balanced approach. I want to listen to the Bulls. I want to listen to the Bears, get the information, and then make a decision from there. But I will say this: it is very abnormal for prices to continue to rise the way that they're rising, even in light of inflation or possibly hyperinflation. So you guys keep your eyes posted. Make sure you hit that like button and subscribe button so you can get more information, stay up to date on what's going on. It's going to be extremely important, like I said, over these next 12, 18, even 24 months, that you're paying attention to the economy, because if things do dry up, they're probably going to dry up pretty quickly. So, yeah, man. Again, as always, appreciate y'all stopping by, rocking with your boy, and until the next episode, peace and blessings. I'm out.